Ever feel like the world of investing is just for Wall Street experts? Well, stick around. In the next few minutes, we're going to break it all down and give you a clear roadmap to start making your money work for you instead of the other way around.
All right, let's kick things off with a big question. We're all taught that saving money, putting it in a bank, that's the safest thing to do, right? But what if I told you that by letting your money just sit there, you are guaranteed to be losing money every single day?
So, what's going on here? Well, it turns out there's a silent thief that is constantly, quietly chipping away at the value of your savings. And its name? Inflation. Think of it this way. The $100 you have in your wallet today, it's just not going to buy you the same amount of stuff 10 years from now. As the prices for groceries, gas, everything, as they rise over time, the purchasing power of every single dollar you've saved goes down. It's a silent, but absolutely relentless thief. Okay, so this brings us to probably the single most important rule when it comes to growing your wealth. For your savings to actually grow, for real, your rate of return has to be higher than the rate of inflation. If it isn't, you're basically on a financial treadmill. You're running hard, but you're not actually going anywhere. And that's exactly why you need to know your why. Really think about it. As you can see, there are tons of reasons to invest. Are you just trying to beat inflation, or do you need to generate some extra income? Maybe you're saving up for something huge, like a house. Your personal reason for investing is what's going to define your entire strategy. And look, figuring out your why is huge because it helps you steer clear of a major trap, treating investing like it's a trip to the casino. It is so crucial to understand that smart investing isn't about rolling the dice. It's a disciplined strategy. So what even is investing, really? Well, at its core, it's pretty simple. You're committing your money today with the reasonable expectation that it's going to grow into more money down the road. The key phrase there is a reasonable expectation of a positive return. This table just lays out the difference perfectly. Look at these columns. Investing is a long-term game, right? It's based on analysis with a real focus on protecting your capital. Now, look at gambling. It's the total opposite. It's super short-term, it's based purely on luck, and there's zero concern for protecting your money. You have to ask yourself, which column describes the mindset you want to have with your money? So once you've got that investor's mindset locked in, the next step is to choose your path. You can think of all the different investment types as avenues, and each one leads to a totally different kind of destination. Now, most of these avenues fall into two big buckets. On one side, you have fixed principal investments. This means your initial money is pretty safe, but, your potential returns are generally lower. On the other side, you have variable principal investments. Here, your initial investment can go up and down, which means more risk, but also the potential for much, much higher growth. It's that classic risk versus reward trade-off. And here's a great way to picture that exact trade-off. On the left, you've got things like government bonds or savings certificates. They're safe, they're steady, they're predictable. Then on the right, you've got stocks, which represent a tiny piece of ownership in a company. They offer the potential for some serious growth, but that growth is never, ever guaranteed. So let's put some actual names to these categories. In that fixed principal bucket, you'll find things like savings accounts, government bonds, or even corporate bonds. In the variable principal bucket, that's where you'll find stocks, or what are sometimes called equity shares. And then there's this whole other world of non-security investments. We're talking tangible things you can actually own, like real estate, commodities, or even art and antiques. And this quote, it really gets to the heart of the matter. An investor doesn't just save money. They choose a specific route that fits with their personality and their goals. This isn't a one-size-fits-all kind of thing. The path you take, whether it's more conservative or more aggressive, is a deeply personal choice, and it's all based on your goals and how comfortable you are with risk. Okay, so this is where the rubber meets the road. You've got the core concepts down, but now you need a map. This 7-step plan is exactly that. A clear, structured process you can follow on your investment journey. Let's just quickly walk through this roadmap. It all starts with step 1, setting your goals. That's your why. Step 2 is figuring out your personal risk tolerance. From there, you get into the real nitty-gritty, allocating your money, selecting specific things to invest in, and then actually building your portfolio. But it doesn't stop there. The last steps, monitoring how you're doing and rebalancing when you need to, are absolutely crucial for staying on track. And you'll notice this process isn't a straight line. It's actually a continuous cycle. See, investing isn't a set-it-and-forget-it kind of deal. You have to regularly check in on your portfolio and make adjustments to stay on course. This process is your repeatable map for making sound decisions over and over again. Let's just zoom in on that first step because it is so critical, your objective. The answer to this one question drives literally everything else. Are you looking for income right now, long-term growth for the future, or are you just focused on keeping your principal safe? You can't hit a target you haven't defined. Then, once you know your goal, you have to answer an equally important question for step 2. How much risk are you actually willing to take to get there? Your honest answer here is critical because it's going to determine the perfect mix of safe and growth-oriented investments for you. So, there you have it. We've gone from understanding that silent threat of inflation all the way to a clear 7-step roadmap for your financial future. You literally have the map in your hands now. The only question left is what goal are you going to write down for step 1?